All right, today we're jumping into a really fascinating technical report on a company called MSP Recovery, stock ticker MSPR. We're going to play detective here and piece together the clues to figure out what is behind one of the most contradictory, just wild stock charts you're ever likely to see. Let's get right into it.
So right off the bat, here's the core mystery. In one corner, you've got a 52-week high of $35, and in the other, a current price of just over 50 cents. I mean, that is an absolutely catastrophic, near-total wipeout. We're talking a drop of over 98%. For anyone holding this long-term, it's a complete nightmare. But wait, that's not even the whole story. Because on one single day, November 3rd, the stock did this. It just exploded, rocketing up more than 136%. So think about that. This stock is somehow one of the year's biggest losers and one of a single day's biggest winners, all at the same time. And that's the bizarre contradiction we're going to unpack. So this is the big question, right? How on earth can a stock that is in a long-term, undeniable freefall suddenly look like it's headed for the moon? Well, the report we're digging into has a pretty compelling theory, and we're going to follow the evidence together, step by step. Okay, first things first. Before we can even touch that incredible surge, we have to understand the crash. We need to look at the grim long-term reality of the stock, because that's the only way that one-day spike even begins to make sense. And the report does not pull any punches. It calls the long-term outlook a structural bear market. Now, that isn't just some fancy analyst jargon. It means the underlying trend is deeply, fundamentally broken. We're not talking about a dip you buy. We're talking about a situation where the foundation itself is cracked. And this timeline here, it really tells the story of the last few months. You can see the steady bleed through August and September. Then the floor just drops out. The price collapses from over $1 all the way down to 31 cents. It finally hits rock bottom on Halloween, of all days, just before that insane pump on November 3rd. It's a textbook penny stock collapse.
So let's get into the technicals. What were the actual red flags waving in the data? What was screaming danger, stay away on the long-term charts? The report lays it all out, and it is crystal clear. Real quick before we see the data, let's talk about moving averages, or MAs. All they are is the average price of a stock over a certain period, like 50 or 200 days. You can kind of think of them as the stock's long-term pulse or its healthy trend line. And if the current price is way below those long-term averages, well, that's a huge sign that something is very wrong.
And wow, the bearish evidence here is just overwhelming. The price is a staggering 94% below its 200-day moving average. A death cross, which is a super bearish signal, is confirmed on pretty much every chart you look at. The trend is just powerfully negative. There is simply nothing in the long-term data that looks healthy. Okay, so we've established the long-term picture, and it is a disaster. Now it's time to pivot. Let's flip the script and look at the short-term signals that lit the fuse for that 136% explosion, and see why this stock is such a fascinating puzzle.
In this slide really captures the whole conflict perfectly. On the left, you've got all those long-term signals screaming get out. But then on the right, you've got these short-term indicators suddenly flashing green. Things that measure momentum are pointing up, and most importantly, you have that massive volume spike. So, which story do you believe? And this is where the report drops its big theory. It argues that this sudden burst of activity isn't a real recovery. No, it's something else entirely. It's a short squeeze.
So what in the world is a short squeeze? Well, in simple terms, you have traders who are betting the stock will go down. But if the price suddenly shoots up instead, they start losing money, and fast. They're forced to buy shares to close out their bad bet, and all of that forced buying just adds more fuel to the fire, causing this explosive, but often very short-lived, spike.
And here it is, Exhibit A. The smoking gun for a short squeeze is always the volume. Just look at this. The average daily volume was about 21 million shares. On November 3rd, over 871 million. This chart says it all. This isn't normal market activity, it's a stampede.
Now let's look at the other clues. The volume was more than 42 times its normal average. That might even be a record for this stock. Then you have the Money Flow Index, or MFI. Think of it as a gauge of how much cash is flooding into a stock. Anything over 80 is considered really overbought. This thing hit 93. It was basically boiling over.
So the report just connects the dots for us right here with this simple little formula. When you see that kind of volume explosion happening at the same time the MFI is over 90, the diagnosis is pretty clear. You're looking at a short squeeze, or, to be a little more blunt, a pump. And just like that,
The mystery is solved.
So, if we know what this is, a temporary, manufactured event, how in the world would a trader even think about approaching it? This is where we shift from just analyzing to talking strategy. But I've got to say, this is where things get extremely risky.
The report is really smart about this, breaking down its ideas by time frame, which is absolutely critical here. For the next day or two, a speculative buy. For a few days to a week, high risk. And anything longer than a week, a huge red X. Get out. This isn't an investment, it's a trade with a very, very short expiration date.
Now, for somebody who might try to ride this wave for a few days, the report gives very specific rules. The price has to stay above 50 cents, the profit target is up around 90 cents, but look at that third rule. It's the most important one. If that daily volume dies down and drops below 50 million shares, the party is over, you get out. Because when the volume vanishes, the pump has no more fuel.
And for the quickest of traders, the scalpers, the plan is even more precise. This table lays it all out. An entry around 52 cents, a target near 70, and a hard stop loss at 45 cents. This is all about knowing exactly what you stand to win or lose before you even get in. It's about strict risk management.
Now, before anyone gets any ideas, the report just hammers home all the risks. And they are serious. The volatility is so high, it's officially rated insane. This has every single hallmark of a classic pump and dump scheme. The indicators are all screaming overbought, which means a reversal could happen at any second. And most importantly, there are zero business fundamentals supporting this price. None.
The report's final verdict really ties it all up in a neat little bow. This isn't some amazing comeback story. It is a classic microcap pump after a 99% crash. The huge gain didn't happen in spite of the crash. It happened because of it. The crash is what created the perfect conditions for this squeeze to happen.
And we end on what is without a doubt the single most important sentence in the entire analysis. This isn't an investment. It is a pure gamble. Any money put into a situation like this has to be money you are totally 100% prepared to watch disappear. It's that simple.
And that really leaves us with something to think about. The story of MSPR is a perfect case study of market psychology, you know? It's where this long-term, ugly reality collides with a short-term, manic frenzy. It forces every trader to ask themselves a really tough question. When you're faced with signals telling you two completely different stories, how do you know what's real?